So you are brand new to investing, you're ready to get started, you know you want to invest in index funds, but the big issue is you can't really decide on whether to invest in the S&P 500 or the total stock market. Are these index funds almost exactly the same? And if not, what are the big differences that really will help us determine which one is best to invest in? Is there really a measurable difference between the S&P 500 and the total stock market? Alright guys, this video is for the brand new investor out there, the average Joe who wants to get started with index funds, wants to truly understand the differences between the S&P 500 and the total stock market. In my opinion, the best way to compare the total stock market and the S&P 500 is to take a look at Vanguard's website and their two most popular index funds. The Vanguard Total Stock Market Index Fund, VTSAX, as well as the Vanguard 500 Index Fund, VFIAX. These are known as passive index funds that track an index. We don't have a portfolio manager that is actively making buy and sell decisions on a daily basis. It is a very passive investment tracking an index with very few changes along the way. Even though we're looking at the index fund versions of both of these index funds, you should know that they also have an ETF. Each one of them does. For the Vanguard 500, you have this ETF right here, VOO, the Vanguard S&P 500 ETF. And then for the total stock market, we have the Vanguard Total Stock Market ETF, ticker symbol VTI. These are fundamentally the same investments, the same assets. It's just there are different ways that you trade an exchange-traded fund versus an index fund. One of the biggest reasons why people choose the ETF versus the index fund is because there is a minimum required initial investment for Vanguard for both of their index funds of $3,000. After you have that initial $3,000, you can invest for as little as $1 every month. Both of these funds have an expense ratio of 0.04%. Now to put this into perspective, let's say you had $1,000 invested in this fund. You would multiply that by 0.04%, and you would mean 40 cents. Just 40 cents every year as an expense for Vanguard to run this fund for you. So expense ratios are the same, minimum required investment is the same. Now let's take a look at the differences in the price as well as their underlying investments. For VTSAX, you'll see that the price per share is $103.14, and for the Vanguard S&P 500, the current price per share is $389.09. Now one of the biggest questions I get on a lot of my older videos is, well, wait a minute, it's got to be better for the average Joe investor to invest in the one that has the lower cost per share because that means I can buy more shares and that means my investment's going to grow more. But that's not true. Whether you invest $100 in the S&P 500 or the total stock market, forget the cost per share, you're still getting the same type of investment returns. Even if that means that you have less shares of one investment or even less than one share completely in one investment, you're still getting the same types of returns. Now let's fundamentally talk about the difference between the S&P 500 and the total stock market. The S&P 500 is considered to be the best gauge of the large cap, or in other words, large companies in the United States. It includes the 500 leading companies and covers approximately 80% of available market capitalization. When they say market capitalization, just think total value. So when you think about the total value of the United States stock market, the S&P 500 makes up 80% of that. Facebook, Google, Amazon, Apple, etc. A lot of the biggest companies, Coca-Cola, Pepsi, the biggest companies in the United States, these are the ones that are in the S&P 500. So the easiest way to think of this is the total stock market includes all of the companies in the S&P 500, but it also includes 3,500 more companies. The S&P 500 has approximately 507 different holdings, whereas the total stock market has right here 4,136 different companies. It has all of the large companies, all of the middle-sized companies, and all of the small companies, a little bit of everything. So with the total stock market having 3,500 more companies in the index, you would automatically think this has got to be a better index for us. Well, maybe. Let's take a deeper look at both of them to see what's actually in the funds. Okay, S&P 500 here, VFIAX. Let's take a look at the portfolio. 507 companies in the index. From a sector breakdown, you can see that it's very balanced. There's quite a bit in information technology. That's going to be in both of them actually, 28.7%, but then 13%, 11%, 12, and 10 across communication, consumer, financials, and healthcare. Now, the top 10 largest holdings, Apple, Microsoft, Google, that's Alphabet, Amazon, Tesla, Meta, which is Facebook, Nvidia, Berkshire Hathaway, Johnson & Johnson, and United Health Group. The top 10 holdings of these 500 makes up 30% of the total net assets, which is quite a bit. We'll come back to that in just a second. Let's compare that to the total stock market here, 4,136 different holdings. Looking at the sector breakdown, we've got 28.4, then we've got 13, 12, 11, and 15 across consumer discretionary, financials, healthcare, and industrials. Now, top 10 holdings are going to look very familiar. Apple, Microsoft, Google, Amazon, Tesla, Meta, Nvidia, Berkshire, Johnson & Johnson, United Health Group. Exact same 10 holdings, and you'll notice here the top 10 holdings make up 25.1% of the total net assets. One of the biggest things you need to be aware of is that both of these index funds are known as market capitalization weighted. What does that mean? It means that the companies that are the largest, the biggest companies, have the biggest share of the pie. So when you put $1 into either one of these funds, most of that money is going to these largest companies, and then a little bit of your money is going to a lot of different companies. Many people would argue, and I've argued this in the past, that the best solution would be to have a little bit, an equal amount of every company. However, from a management standpoint, it costs a lot more money to do that because you have to rebalance the companies more times per year, and it costs more money to do that. So again, in the total stock market, the top 10 holdings make up 25% versus with the S&P 500, we were at 30%. And this makes sense, right? Because we've got a lot more companies to invest in with the total stock market, it would make sense that we have less money going to the top 10. However, if we think about this, the top 10 of 500 versus the top 10 of 4,100, you would think that you would have a much smaller percentage in the top 10 holdings, but the reality is this is how the market capitalization weighting works. And if you look at the top 10 holdings based on weighting, you'll notice for the S&P 500, we've got 7, 6, 4, 3, 2, on these top 5 holdings right here, Apple, Microsoft, Alphabet, Amazon, and Tesla. And then just slightly lower here with the total stock market, 6, 5, 3, 3, and 2. From a dividend yield standpoint, the total stock market, VTSAX, has an annualized dividend yield of 1.61%, whereas with the S&P 500, it's at 1.58%, so almost exactly the same. Let's take a look at performance, but instead of just looking at charts on their website, I went ahead and built out a spreadsheet, which I like to do, that shows you just what it would look like to have invested 20 years ago in each of these different investments, both from a lump sum perspective as well as on a monthly contribution perspective. So we can look at what would be the actual differences in performance between these two funds. So we've got all of the data here for VFIAX, as well as for the Vanguard Total Stock Market, VTSAX. We've got all dividends being reinvested. We've got monthly contributions of $250 a month, going back all the way to December of 2000. Let's take a look at what the difference would be and how much money you would end up with investing for 20 years. Now, this first chart we're looking at here is assuming a lump sum investment of $100,000 20 years ago. I don't expect anybody out there, any average Joe, to all of a sudden have $100,000 to invest at one time. I'm just trying to give you a little bit different look here. We're gonna look at monthly contributions starting from 0 in just a second. But just to get a different view here for those that have money to invest, at one time, what would the difference be in the performance with starting with that large amount versus starting with 0? And we're also including monthly contributions of $250 a month. And you'll see here the investment performance is very similar. For the most part, the total stock market was on top here, although they're almost exactly the same. What's interesting though is that really at no point during this process was the S&P 500 on top. A $100,000 investment back in December of 2000 and investing $250 a month, the total stock market would be worth $584,000 and the S&P 500 would be worth $550,000. So a $30,000 difference. Now if we look here, it's interesting. If we start with $0 in the investment account and we make monthly contributions of $250 a month, both starting at 0, in the end, they're almost worth exactly the same amount of money. $232,078.69 for the total stock market, and for the S&P 500, $231,168. So almost exactly the same amount of money. But you'll notice the spread in this one is a lot different. For the most part, they're almost exactly the same. And you don't have to use Vanguard. I just chose these for the example purposes. Schwab's got a great S&P 500 large cap fund. So does Fidelity. All the big brokerages have really great low cost index funds. The one thing you might just really like about the total stock market though is you just have a lot more investments to invest in, though you're still putting the same amount or very similar amounts of money in the largest companies because of that market capitalization weighting. You still get a little bit more diversification with the total stock market. One of the things we noticed over the last couple of years was that the total stock market was outperforming the S&P 500. And the reason why is because the S&P 500 has very clear methodology for their index. You have to be part of the S&P 500 to be in the index. And sometimes you have to meet clear criteria to be included in the S&P 500, including market capitalization, making sure you don't lose money or make a profit for a certain number of consecutive quarters. One of the companies that was in the total stock market much earlier than it was in the S&P 500 was Tesla. Tesla had a lot of volatility and variability in their profit year over year and quarter over quarter, and as a result, they were in the total stock market much earlier than the S&P 500, and that led to some noticeable outperformance in the total stock market. However, since then, since it's in the S&P 500 now, there's really no measurable difference here. For me personally, I do not invest in either one of them. I actually do a slightly different approach. I still try to tackle the total stock market, but I do it with a little bit more equal weighting across large cap, medium cap, and small cap. I do it with a specific fund for large cap, a specific fund for mid cap, and a specific fund for small cap, and I do equal weightings across those. When you utilize the total stock market, you think you're getting the total market, but really you're getting mostly the big companies and a little bit of the small companies. If you like this video, guys, check out this one right over here. It's a great next step for you if you're learning more about how to invest in index funds. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.